All right. Oh, hi, Dr. Mark Calabria, Director. Hello.
Faith, hello, how are you?
Great. So welcome back. This is the last segment of our town hall. I just want to let you know this is Dr. Calabria. This is being translated in Chinese. It's being aired right now in New York, Houston, Philadelphia, Chinatown, Seattle, and here in Los Angeles. And it's also live in Facebook. And in light of the show of hatred in the Asian community. This has been our focus since this morning on loving each other. Really, this is not about any other communities. I mean, we got to stop. We already had a a big problem when George Floyd died. Why do we have to kill more Asian? And we all know that Asian is an invisible community, but Asian is a major factor in this country, and we all are. So we're hoping that with this conversation also, and we'll focus on that. And if I could ask, we're gonna talk slowly, so it's being translated properly, and. Mr. Brian Brooks is trying to come in, technology. So, but meanwhile, I'd like to have a fire chat with you. So, ladies and gentlemen, Dr. Mark Calabria, Director of College FA. College FA oversees Fannie Mae and Freddie Mac. For the consumers, you see that when you mortgages, that's under Fannie and Freddie. The lenders, the servicers, they sell their loans to Fannie and Freddie, and FHFA, Dr. Mark Calabria, is overseeing that. So he plays a major role in this pandemic. It was already hard before pandemic how to buy a homes, right? The access to capital. So what more? But I'm seeing a lot of relief. Chairman Jelena McWilliams talk about how they're being proactive, and all the CDFI, the MDIs, the lenders have been helping homeowners and renters. And I know I see a lot of help coming from Dr. Calabria's office. So, Dr. Calabria, if you can please address everyone on what College FA is doing and how sympathetic you are also in the Asian community.
Well, thank you, Faye, for the welcome, and certainly welcome everybody, and good afternoon. Let me first just very much, share that. Yeah, it really is just such a heartbreaking year in so many ways, and to see recent events, and I am someone ultimately who believes that love can be the greater victor in the long run, and that we can see our commonality and our common humanity. So I really do appreciate you starting on that note and pointing that out. One of the things that always goes back to me, when I was raised learning about, the Italian American community, we'd always look at that Immigration Act of 23 and reminded that it was fundamentally addressed at trying to keep Chinese Americans and Italian Americans out of this country. And, I feel very lucky because my grandfather came in 23, right before the 1924 door was shut for so many people. And again, so much of that was aimed at the Chinese immigration that came, that built so much of the West Coast of our country. And it really is just such a foundational element of how much of America was built with immigrant labor. And it really touches home for me because so much, we deal with housing, we deal with the built environment. And again, so much of the built environment, the sweat, the labor, and unfortunately, sometimes the stories that we grow up and learn about the bodies encased in concrete because of dams and construction, and those were immigrant laborers, and I really do take it to heart every day. and hope that we can turn a corner in that regard. So I really thank you with that. And let me, maybe as a bridge to COVID, I live in Washington, D.C., and I'm fortunate to be, in a part of town where I feel very safe. And like many of us have been able to work from home. And one of the things I do every morning is look at the Washington, D.C. COVID map. And certainly one of the most powerful reflections of the COVID experiences, it has not been equally distributed geographically or by occupation or by ethnicity. And it has had a very disproportionate impact, which is one of the reasons, and I'm very proud of the job that FHFA has done. We acted almost 3 weeks before Congress passed the CARES Act. We set up forbearance programs, not simply on the single family, but on the multifamily. And on the multifamily renter side, we had never had a forbearance program before. The single family, we took what we had done in natural disasters, whether it was Sandy or Maria or Katrina, and we had built that out for COVID, but we had never had a renter assistance program. And one of the things that really struck me in March of last year was that the data were very clear coming in that this would be a housing impact that would disproportionately hit renters. Because unfortunately, it's renters that disproportionately work in services, work in tourism, work in leisure, hospitality. And so we needed to come up with a solution that wasn't just about homeowners, but had to have a renter solution as well. We also, unfortunately, there were about 200,000 families that were already in some part of the foreclosure process before COVID even hit. And many of these families had not been able to pay their mortgage for over a year and plus, but we had to put an additional lens, relative to what we've done in the past in previous recessions, previous crises, to put a public health lens on this. And so we wanted to make sure that everybody could stay in their home so that, obviously you didn't want to have a situation where somebody would be evicted, they would be exposed to the virus. You didn't want to have a situation where, sheriffs or anybody else in the courthouse or the city would come by and be in the house. So we really wanted to the greatest extent possible facilitate social distancing. Also say as an aside, because I think this is important, but I see this less important than the direct assistance we provided. We also created a number of flexibilities in the mortgage market because, again, we wanted to have an environment where you could refinance, where you could buy a home, but you could avoid having an appraiser or a home inspector, somebody come into your house, you're exposed to them exposed to you. Certainly one of the things that we were reminded by COVID was how much of the real estate process tends to be person to person. And we really tried to create a lot of flexibilities to get that going so that people could still achieve the dream of home ownership. People could keep their home, but again, we can allow this done at the distance. I think we've learned a lot technology wise. I'm very proud of the response we have. Obviously, Fannie and Freddie were only a part of the market, but we had over 2 million single family forbearances. I'm happy to say that about 60% of those have cured. Borrowers have gotten back on their feet. We helped about 200,000 renters stay in their homes directly for Fannie and Freddie. Obviously, that's only a small part of the market. I think it's a real testament to the job we did that working with our partner agencies, particularly FHA and HUD, USDA and others, we really set up standards that you then saw most portfolio and most private label lenders mirror. So the standards we came up with, and again, we only had, 40% of the multifamily and about 60% of the single family, but the standards that we were able to come up very early on, I think were ultimately adopted probably by about 95% of lenders, maybe with some small differences, but you really saw that embrace. And I do want to commend, the entire real estate industry, the lending industry. And I don't want to sound a little hokey about it, but I think the reality is we were able to keep people in their homes, and that fundamentally saved lives because we were able to protect people from being exposed. And I'm very proud of those efforts. And we were all being able to do that from working from home to the extent that we can. And of course, reminding ourselves on a daily basis about those who aren't able to be able to work from home.
Yeah, Dr. Calabria, I personally want to thank you because there's a lot of renters that we are serving that they are not being evicted because of what you're doing. And I really want to thank you for that. And the homeowners that are getting forbearances, that is such a great thing to do. And we just have to hope that when the forbearance ends and, on the first panel, PG&E, they have like 500 million of past due bills that hopefully their credit score will not go down, because right now it's not reported.
It's a very real issue with the credit scores, and we've extended our single family and multifamily forbearance programs to June. I think we'll probably end up extending them to August or September. I'm hopeful that at that point, I hope by July, say that everybody who wants a vaccine will have gotten one, and we can start to get back to normal. And my expectation is probably by August, in the Fannie and Freddie portfolio, we'll probably have 200,000 to 300,000 single family borrowers who are still in forbearance. Other parts of the market like FHA will probably have a deeper severity, but we'll probably have writ large close to 1 million borrowers who the question really has to be, what's the permanent solution? And in some cases, there may be modifications to the principal, there may be rights on the interest rate, but how do we make these permanent solutions so we can help people get back on their feet again? And I'm hoping that's a conversation that we can start, cross government, across stakeholders, so that there can be some commonality and consensus on what the long-term solution should be.
Great. Well, I'm so glad Brian Brooks is here now.
Here I am. Thank you for letting me in.
Okay, here you go. Take it away, Mr. Brian.
Well, Faith, first of all, thanks for having me, and Mark, it's great to see you on this side of the call. What a great thing for Faith's organization here to have you here. I just wanted to pick up on something you just said a second ago about all of the different stakeholders in the system, because I think a lot of times politically people think it's just a simple choice to decide, should we have a mortgage forbearance or not have a mortgage forbearance? And the truth is, the housing financial system depends on lots and lots of participants. And on a given moment, losses or costs have to fall on somebody. And so I wonder if it's worth educating the audience just for a minute about the idea that, if you have something like a COVID shutdown, and so somebody loses their job and can't make the next month's payment, there's a choice to be made about whether that next month's payment should be borne by the investor or the homeowner or the servicer or somebody else. And you and I spent a lot of time talking about servicer issues in particular as one of the early stage issues we had to deal with here. Can you just talk a little bit about how the pieces of the puzzle fit together and how complicated what you achieved is?
Well, thank you for recognizing, Brian, that. And it's a really, partly, I think some people know, my background, the doctor there in front of my name is not because I'm a physician. So it's because I'm trained as an economist, which probably is less impressive to my mother, but than if I was a physician. But all that said, I always think about trade-offs. And certainly when we went down this road a year ago, we looked at this, we calculated numbers, and to put it in context, we think today that all of the COVID assistance that Fannie and Freddie have provided will cost at a minimum $8 billion. It may even cost us as much as $20 billion when all is said and done. So we went into knowing that this wasn't going to be free, but we thought it was the right thing to do. We thought in the long run, it would minimize losses to Fannie and Freddie, because of course, you try to foreclose on somebody, in the middle of a pandemic, that's not going to work well for protecting the value of the collateral. It's not going to work well for the borrower. It's not going to work well for Fannie and Freddie. So I know it's a bit of a cliche to sort of say win, 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 but we did think that we came up with some solutions that were a win for the borrower in renters, a win for the lender, and a win for Fannie and Freddie. And I'm proud to say we did it all without a penny of cost to the taxpayer. Now, of course, there was a little bit of blowback when we instituted a fee on refinancing to pay for keeping people in their home. Not everybody loved that, but again, we were able to pay for the cost of COVID within the system. Again, we had to make it transparent so we could see how those costs are being recouped. But I do think that sometimes there's just not a recognition of that there are costs imposed. And Brian, you talked about the servicer issue. So normally, when the servicer collects the monthly principal and interest and advances that to Fannie and Freddie to advance to the investor, there's a little bit of what we call float there, where the servicer is carrying that payment before they get reimbursed. And certainly there was a lot of concern from servicers that, the forbearance would spike, they would run out of liquidity, and essentially some of them would go bankrupt. Now, we really looked at the numbers. One of the things that we did early on was to say, Fannie and Freddie were only going to require the servicers to forward the first 4 months. And then after that, we would take over the cost. And of course, that was a recognition of that there would be a cost in Fannie and Freddie. Another good example of this is that the most common way that borrowers have cured out of forbearance are a payment deferral option that we've set up, where let's say you missed 4 months of your mortgage, we tack it on to the end, kind of like a balloon, so that your monthly payment when you start again is the same monthly payment you had before. So there's no payment shock, and you pay back the missed payments essentially when you either refinance the loan or sell the house. So we think that's a very good deal for the borrower. You have to pay it back, but you're also getting an interest-free loan for that time. And of course, we're forwarding that interest to the investors who hold the MBS. So that's a cost to us, but we're making it up elsewhere in the system. So again, it's always important to recognize that just because there are costs, that doesn't mean there aren't benefits, and you try to weigh those, and you try to do it in a way where you can protect the most people and help the most people, but that you are transparent about the costs that are involved. And I think we've tried to do this in a very transparent manner. We didn't lose Brian, did we?
I think we did.
Oh, okay. You know, and I thought he was supposed to be a technology whiz.
I'm back. I'm the technology whiz. I'm just not the phone company, but I am back. I heard what you said. I got cut off for a moment, but here I am. So hey Mark, can I just pick up on that for
Absolutely.
a second? Because to me there are two sides of the equation, right? So one side is, where does the loss fall? But then the other side is, you know, who do we need to be focusing on in terms of protecting? And one thing I'm going to guess a lot of people on this broadcast may not be aware of is, you know, if you read in the newspapers every day, you would be of the view that there are a huge number of people struggling out there and the economy is in really a bad place. And there's some evidence to support that, right? I mean, the unemployment rate is roughly not quite double where it was 14 months ago. Clearly, certain sectors have been thrown out of work. There are certain sectors that are really in bad shape. On the other hand, as a result of programs like the PPP program and federal unemployment supplements and a series, you know, direct cash transfers to people below a certain income level, average savings in the United States is actually higher today than it was when we went into the pandemic. And so, help us think through, when you were looking at this, what kind of default rates did you anticipate? And at what point did you decide certain things had to be done and all of that? Because the data was a lot murkier than I think most people would know if they just read the newspaper headlines.
Great question. So one of the things that we saw, early in the pandemic, was the initial unemployment claims data. My analytics team was able to really quickly conclude that only about 40% of the unemployed were likely to be homeowners with a mortgage, and that it was going to predominantly be a renter crisis. And so that was one of the things that we immediately said, we need to set something up for renters. Because, and not that we didn't want to focus on homeowners, but again, we had our expertise there, but we really felt early on that this was going to be a predominant impact on renters. So therefore we needed to focus on that. So that was one of the things we saw. One of the positive things we did see was that, okay, unlike the Great Recession, where you had a large number of homeowners who were underwater on their mortgage, we quickly saw in our data that most of these homeowners had equity. In fact, less than 1% of Fannie and Freddie borrowers in forbearance have loan to values over 97. I don't want to say nobody's underwater, but almost nobody in the Fannie and Freddie forbearance book is underwater, which is different, of course, in FHA, and that's a separate conversation. So, we saw this wasn't an insolvency issue. This was a liquidity issue of, here were going to be families who were going to have a tough time for a few months. For most of them, when the economy started to reopen, their job would come back. And of course, there will be some of them where we'll talk about where those jobs may not come back as quickly or may not come back at all. So we looked at this and just said, it really looks like for a lot of these families, they need a short-term bridge. They're going to be able to pay it back. They just need some liquidity help for a little bit. And that's really where our initial program was set. I will be the first to say we took a little bit of a gamble on one aspect, which is we looked back at the HEAP, HARP, and other experiences in the Great Recession, where there was what I call the great paperwork chase, where there was just so much paperwork between the lender and the borrower and all these things, and people would get their applications rejected because something wasn't filled out right. So quite frankly, I knew I was taking a gamble at the time to say, let's do this the honor system. We said, okay, we're going to ask the borrower when they sign up, are you suffering a financial hardship from COVID? If you say yes, you're eligible. We're not going to make you fill out a lot of paperwork. And I think I was one of the few people who went on TV and elsewhere and said, please, if you can pay your mortgage, do that, because we need to focus our resources on those who can't. And I am happy to say that at least our internal data, this was not abused. At least in the Fannie and Freddie portfolio, it really looked like the people who signed up and took it were the people who need it. And you didn't have a lot of people who didn't need it take it. So again, and that's always a risk, because anytime you tell someone they can just stop paying. And of course, you may remember, I'm sure you very much remember, Brian, but there was a lot of commentary out there in the media about a year ago about, well, all mortgages are going to be forgiven, all rent's going to be forgiven, nobody has to pay anything back, or if you do have to pay it back, you have to pay it back in one lump sum. So there was just so much confusion all across the board that we found frustrating. But so we acted very quickly. One of the unusual things we did, for instance, was we at FHFA wrote the servicer scripts. We were like, okay, this is the script that we want Fannie and Freddie to give to the servicer, so that whoever the borrower is, whoever the lender is, if it's a Fannie and Freddie loan, they get the same treatment. They get the facts from us. They don't get spun by a servicer. They don't get confusing by, and of course, obviously there were some problems in the implementation across the board. I'm never going to pretend that everything was executed perfectly, but we really did want to make sure that we could reduce the confusion. I was out there in the media telling them, listen, no one's got to have to make a lump sum payment. We're going to work with people to get them back on their feet. So again, trying to get through some of that confusion, I think was critical, and I think we got there pretty quickly. But yeah, you have to be transparent about it. You have to be willing up front to think about what are the losses you're willing to carry and take, and how do you target this. And as you got to, and one of the frustrating things, I'll go back and mention again, the adverse market fee that we created to pay for this. So I thought this was quite fair, and I'll walk you through it. And hopefully when I walk you through it, you walk away and think it's quite fair too for the general audience. But so we know quickly that we were going to have billions of dollars of expense to do this for Fannie and Freddie. Our first estimates were at least 5 or 6, and now it's a minimum of 8. But we said, this is going to cost us money. It's the right thing to do, but how do we recoup it in a way that's fair? So we said, okay, there are a lot of borrowers that, as you have alluded to, Brian, who have not lost their jobs, who are actually in pretty good state financially. They've gotten relief payments, they're saving money, and they're going to refinance and lower their rate. And so what we said is, okay, here's a segment of households who were doing okay, and in some sense actually doing better financially. And then here's another segment of households who have lost their jobs, who may be facing losing their home. And so what we did was create this refinance fee on the households on the upper end, and we excluded smaller balance loans. So essentially, you could say we kind of taxed those who were actually doing relatively well to subsidize those who were facing real hardship. I thought it was a very fair system. There was some external criticism about it out there, but I still think it was the right thing to do. But it really made explicit and transparent that who are you trying to target assistance to versus who's going to pay for it. And I do think there's been a tendency to just say, let's give assistance to everybody. And I understand the attractiveness of that. But, I personally was dealing with 2 balance sheets, limited resources, and had to triage. And part of the reason I really took this attitude was, I was on the banking committee and I had other seats, and I know you had some interesting seats during the Great Recession as well, Brian. But I think it's fair to say that the governmental response to the Great Recession and 2008 crisis was often to throw money at people who didn't need it as much and ignore people who did need it. And I felt we needed a really good system, if you will, triage of who needs the help the most. How do we focus assistance at with people that would otherwise fall through the cracks? And how do we not just throw money at everybody? And again, perhaps that leaves me as the odd man out today in today's circumstances.
Not on this panel, it doesn't. So Mark, I would just make a couple of comments on it. I mean, first of all, I think that you justly got a lot of credit for being the one clear voice cutting through a lot of disinformation as these programs were rolled out. And I think there was a lot of fear. I mean, look, it was a scary time, and it seemed like the bottom was falling out of things. But I think you rightly got a lot of credit for clarifying what was really going on. I would say from where I sat, just as one other comment on this, we saw some really interesting data at the OCC where in the early days of the forbearance program, in month 1 and month 2, there was a surprising number of people who had elected forbearance who made that month's payment and maybe the next month's payment, but then stopped making the payment the next month. And I think what was going on there was, and this says a lot, I think, about the country that we live in, is people who could pay, even people who lost their jobs, but could pay out of savings, were going to try to do that. And they were taking a forbearance as kind of an insurance policy against worst case scenarios, believing, as we all did at the time, that this was going to be a 30 or 60-day problem, not like an indefinite problem like it's turning out to be. And I think the willingness of people to try and pay out of savings before turning to the taxpayer or to servicers or somebody else to kind of bear that says a lot about what's great about the country. But Mark, the last question I have for you on this topic is, and I know we only have some limited time here, but it is whether in light of COVID, any of that has changed your views about the best way to deliver affordable housing in the country. Historically, we've relied on things like the Capital Magnet Fund, the Affordable Housing Trust, FHA and other things. What do you think the long-term takeaways of this are from an affordability perspective, if any?
That's a great question. And I know some of this is kind of perhaps get outside of the bailiwick of FHFA, but for the sake of what I think is an interesting conversation, and let me start with, COVID very much illustrated the housing vulnerabilities and affordability problems that were there pre-COVID, and it certainly brought those to light, in a way where I think it refocused that, on much of the problems facing our country. So let me say that, to me, I think you have to kind of put things in two buckets, somewhat renter and somewhat homeowner, although there is a common thread where a fundamental problem in so many parts of our country is just the difficulty of building and bringing supply online. So, to solve the housing problems of the San Francisco Bay Area, you need to fix the building process. And again, I will give credit where it's due, in that a number of localities and a number of conversations at the state level of California are happening to try to increase the land use issues there so that you can have housing built. So again, I think writ large, you got to deal with the supply response or the supply problem in a number of areas. So that, I thought, was critical. Secondly, it's really kind of judging what is the biggest barrier that people are facing. And certainly we don't, one of the things I've kind of learned throughout this, both in a response to COVID and also in response to what was, a very healthy, if not, exuberant refinance environment, in a very competitive purchase environment, is that the usual kind of attempt to try to subsidize homeownership via interest rate declines, I think, has, limited bang for the buck. And I don't think you can get a lot out of interest rate declines and interest rate subsidies in the way in which you can in terms of whether it's down payment assistance. So I would say writ large, to me, the part of the lesson on the homeownership side is we should be subsidizing equity, not debt. And the traditional measures that we saw, for instance, debt to income, DTI was a very, very predictor about who took forbearance. And so we do need to think about debt loads. And so I do worry that, we can't continue to try to push homeownership via getting households deeper and deeper in debt. It really needs to be approach of, if you're going to put subsidies at it, how do you subsidize the equity component to give people a cushion? That's one aspect of it. The other aspect of it on the rental side, and again, at the risk of sounding like I'm just reconfirming what I believed already pre-COVID, I'm very much an advocate on the rental side of having voucher assistance where you can move. And I think the really desire of people, you saw these movements out of the cities, you saw these movements where people wanted to try a different lifestyle across the income spectrum. And I think, to me, so much of our built environment is in place. And so much of this, you don't really know where the opportunities are going to be. So I would hope that as we continue to reevaluate federal rental assistance, that more of it looks more like a voucher than looks like the old production programs we used to do.
Yeah, I mean, look, Mark, you mentioned a minute ago some of the lessons of the financial crisis. One of the great lessons was the decline of labor mobility when people don't have options like that, right? So on the rental side, it's about vouchers. On the housing side, it's about preserving home equity.
That's a great point. The 2008 Great Recession, Great Crisis really was, I went back into the numbers at the time, and in most recessions, and you don't have to go back to the 20s Dust Bowl, but in most recessions, almost every recession before that, mobility among homeowners increased. People would say, okay, where I'm living, there's not job opportunities here. I'm going to go move somewhere where there's job opportunities. The Great Recession was the first recession that I know of in American history where homeowner mobility declined relative to trend. And there's a number of reasons for that we could talk about for an hour, but I do think we need to be able, if we want to have a country of vibrant upward mobility, part of that has to be geographic mobility as well.
Yeah, for sure. So Mark, let me just change gears for a second and ask you this question. So you walked into this job as a famous policy expert. But let's be honest, well, let me put it this way: a well-known policy expert, right? But you didn't go into this job well-known as a big, organizational CEO type, and yet you've gotten a lot of kudos for enhancing the productivity of FHFA, for preserving and enhancing the diversity of the workforce, and doing a bunch of other things. Talk to us a little bit about what it was like to step into a big agency head management role like this. What did you learn? What most surprised you about the workforce? What worked and what didn't from a leadership perspective?
Great question, because, and let me say, I feel like I've been very lucky throughout my career to have had terrific mentors and leaders that I have worked for, and I've always tried to learn from their leadership what I could take to heart. And that's a very fair observation. We'll argue whether I'm an expert or whatever policy guy, but I'd be the first to say that I certainly had never managed an organization of this size before, and came into an organization with a number of morale issues and somewhat lack of focus. And obviously the entities we regulated, Fannie and Freddie, had been troubled for a long time. So first of all, we needed to turn around and stabilize FHFA. Now, part of my leadership, and maybe this does kind of connect a little bit to my policy views, which is, I believe the first principle, at least in my style of leadership, and I think it's appropriate for anybody's style of leadership, is you have to start with the modesty and humility of whatever the situation is, you're only going to see a small part of it. And therefore, how do you become an organization where people can raise their hand, where people can speak up? And, part of this is my policy lens of having worked in Washington for 25 some years, is that it's very easy to fall into groupthink. And this is one of the reasons of why you need to have a diverse team. You need to have a wide range of perspectives. It's very easy to fall into believing that your own conclusions are correct. I probably annoy my staff with this when I say all the time that I have enough confidence in my own opinions that I don't pay people to repeat them back to me. I pay people to tell me when they think I'm wrong. I pay people to challenge me. And again, it starts from a modesty of, I'm absolutely got to be missing something in the situation. So for me, I was very lucky to put a great team together. I know a few of them, like my chief of staff, John Roscoe. We built out a great team at FHFA. People who I've known for sometimes 10, 20 years, had seen them in action. They knew what they were doing. We also came in with a very clear vision of what we wanted to achieve and how we were going to engage and empower the staff. And I've made it clear from day one that my job is to be able to create the environment externally, internally, where the staff can do their job. So, again, it also starts with the modesty of, I'm just the guy who gets to take credit for what happens. I mean, granted, I'm the guy who takes blame for what happens too sometimes, but, at the end of the day, I've got to be able to empower the staff to do the job. And also, I brought to this a commitment that probably surprised a few people that, I said, if we need resources, we're going to bring them in. For instance, it's probably not well known that during the year of COVID, we hired over 100 people at FHFA, onboarded them, filled positions. I looked at resources, looked at my management team and said, we don't have the resources to be able to do X. So for instance, I talked earlier about how we identified some of the fault lines in COVID. Well, in January of 2020, I set up a new research division. Lynn Fisher, who is well known within the industry, who's actually a smart policy wonk, unlike me. I hired her, I empowered her to bring a team of researchers in. It was the work of her team that really came to me and said, this is what we're looking at the unemployment market. This is what we're looking at in terms of the numbers. And so when I went out in March and said, we're probably going to get about 2 million forbearances in Fannie and Freddie, and then lo and behold, that's what we got. It was based on the work of that team. So part of this is coming in and recognizing where are the things that are missing. How do you build that up? How do you empower people to do that? And how do you have a very clear message of people being engaged and marching all in the same direction? So I'd like to say that it was all planned and much of it was planned, but I think it's worked out quite well. And thank you for recognizing that. I'm very proud of where we've gotten the agency, and I'm just amazingly proud of the great job that the team at FHFA has done over the last year.
So Mark, what many people on the broadcast may not be aware of is that you and I led different agencies in the same building, and so we were basically neighbors. And I was actually able to see the morale of the agency day by day, and it was pretty impressive. So look, we've only got a couple minutes left. I think what I want to do is clean up here. You mentioned Fannie and Freddie a couple of times, so let me clean up with sort of like the big the big question that capital markets, Wall Street, but probably a lot of housing advocates.
Brian, did you just mute yourself, or somebody has?
Want to know too.
There we go.
We're in sight. Shift
Sorry,
this.
can you go back because we lost your sound?
Okay.
There we go.
Can you hear me now? Are we okay?
I
All right,
can hear
great.
you now, Brian. Sorry.
So perfect. So I'm talking about Fannie and Freddie and about market expectations that there was a good chance, a year ago, 2 years ago, et cetera, that we might finally bring the conservatorships to an end and put the risk back on shareholders and away from taxpayers in some form or fashion. And whether that's ever going to happen now, it's clearly not going to happen in the imminent future. So give us just a little bit of your crystal ball of what does the future look like for the enterprises, and how do you think that affects housing supply, housing costs, the future of housing policy?
Great question. So let me start with that. The statutory framework around the conservatorship is fix them and get them out, or of course, if you can't fix them, take them into receivership. So I would say, and I think it actually touches back to the previous question about morale and building the agency. I really came in with the perspective of, it's not my job to impose my policy wishes. It's my job to follow the law and the legal framework that's there. And the legal framework is you fix them and you get them out. And that if somebody wants to turn them into something they're not, that's Congress's call, not mine. And so all that said, and as I mentioned earlier, we've got at least $8 billion and maybe more costs from COVID. So certainly COVID and the cost of COVID have delayed an exit by probably about a year, because again, the cost of that. But I still see us on the path toward building capital at Fannie and Freddie. And if we get lucky and we're able to do this before there's a turn in the housing market, because again, I'm a guy who thinks that housing markets go up and down. So I certainly think there'll be a turn in the housing market at some point. But if we can continue the next couple of years to build capital, if we can restructure their balance sheet and get them out, I think there'll be a much more innovative and stronger companies. And they can be sources of strength for the capital markets. And one of the things I think that's easily forgotten, we saw this last March of last year when COVID was really kind of roiling the financial markets that third week of March. We saw this in 2008, that when market participants aren't sure about the strength of Fannie and Freddie, their funding costs blow out and widen. And that obviously gets passed along to homeowners. And again, we saw that even in conservatorship in March. So I think if we can get a strong Fannie and Freddie out of conservatorship, it will mean more stability in mortgage rates over the cycle. It will mean more access to credit. And of course, it will mean there won't be a taxpayer bailout. It will mean that there won't be disruptions to the broader market. And of course, Fannie and Freddie securities are owned throughout the financial system. So they are a real systemic risk to the system. And that represents real risk to families and households. So again, we've been delayed, but we're still on track. We're still making the efforts we can. We're still building a dialogue with stakeholders. And I would say more broadly, I think the policy conversation has shrunk, if you will. Certainly 4 or 5 years ago, every other person had their complete, blank slate, here's how I'll completely redo the mortgage finance system. And so I think that that's largely gone. I think the debate is narrowed to, you have these two large companies. How do we fix them? How do we take what's right with them and leverage that? How do we fix what's wrong with them? And basically, how do we basically fix the status quo? And I think that makes it a much easier problem, because then we can get away from the broader debates about, rewriting the system. Anytime you start from scratch, it's going to be divisive, and you're going to have a much harder transition issue. So I think I would really put it this way. I'd welcome some pushback, because again, following the mantra of, I don't need you, Brian, to report to tell me what I think. I'd certainly welcome your thoughts. I think at this point, the only real option in the policy conversation is fixing them.
I think that's a great note to end on. Faith, I'm going to kick it back to you. Thank you, Mark.
Thanks, Brian.
Yeah.
Great to see you.
Dr. Calabria and Brian, can you give advice to our viewers? Like I said, this is being in the Facebook and live in a Chinese radio station, and this is also going to be in our website. Give advice to the renters and what they should be doing, as well as the homeowners.
And Faith, is that in relation to COVID or relation?
Is it okay if you talk a little bit slowly so they can?
My apologies. So I was going to ask whether the question is in relation to what borrowers and renters should do in relation to COVID, or in relation to equity building, home ownership at large, or all of the above, if you like.
Yeah, so I think all of the above, like increasing home ownership, as well as not be afraid that they cannot pay the rent, or or their forbearance.
I mean, it's a great question, and let me start with the current situation, which I'm going to always say, if you're a renter, obviously, the first thing you really should do is reach out to your landlord. And I recognize that not every landlord is going to be cooperative, but I think you will find that most of them are, and they may be underneath some stress, and they may be able to work out a deal with you where they're taking some percentage of the rent. But I think, unfortunately, I think one of the more frustrating things to me this past year is really kind of seen a lot more landlord-renter tension in the media. And again, I'm going to go out on a limb and say, I think people who provide shelter that's God's work. I mean, it's hard for me to think about something more noble than you providing shelter for a living to someone else. And that's what a landlord is. And that's not to excuse a few bad actors, but so I do want to encourage landlords and renters to, again, if you're a renter who's having problems, reach out to your landlord. As you know, Faith, there's the assistance bill that was passed recently that provides a tremendous amount of renter assistance. That is being funneled through the state housing finance agencies. So, if you don't think you can make your rent, or you're having trouble, or you want to pay your back rent, reach out to your state housing finance agency, to look at that as a vehicle to get back on your feet. And of course, Brian and I talked about geographic mobility. I'm very optimistic at the pace of the job market so far, but I think the reality is there's going to be pockets, particularly in tourism, hospitality, leisure, that are not going to come back anytime soon in all likelihood. And so I do have to think you have to ask yourself, for instance, if you live in greater Clark County, Nevada, and Las Vegas, and you were working at one of the casinos, again, it's just an example, that may not come back anytime soon. And you may want to ask yourself whether moving somewhere else is the right solution for you to think about where the job opportunities are. So, but I know those are very tough decisions. And obviously, those are decisions a lot of people have already made over the past year. Again, with homeowners, call your servicer. Almost every servicer is going to be willing to provide some assistance to get you back on your feet in the terms of forbearance. But to move past this, because I am optimistic that we are entering, a light at the end of the tunnel in terms of COVID. Obviously, there's a tremendous amount of competition in the home buying market now. We are short. What I would say for a lot of would-be homeowners is there are a lot of potential sellers who are holding their homes off the market. And you could kind of understand this. A lot of people are going to be uncomfortable having an open house while COVID is still going on. They're going to be uncomfortable looking at another house. And so what I would say is, I think the supply situation is going to get better in 6 to 12 months for homes. But it's not to say hold off if you really want to buy now, but just kind of keep in mind, it's probably going to be a much better supply situation once we get on the other side of COVID. And so spend that time saving for a down payment if you can, if you've been employed in this cycle. It always helps to have a down payment. We've also had an opportunity, while obviously on the forbearance, we put a pause on credit scores, but it's amazing the kind of improvement you can see in your credit score over the course of 6 to 12 months if you really work at it. And again, and as you go to freecreditreport.com, it's a great thing for consumers. And that's actually the first thing you should really do when you're thinking about buying a home is get a copy of your credit report, get your credit scores. And really, it should really be kind of a 6 to 12 month process, especially now on the other side of COVID, where you look at the things that you need to change to get that credit score, because the interest rate and the savings differential, if you can improve your credit score, it's just huge. And also, in this kind of market, and again, we've got, a lot of flexibilities. There are things like FHA where you can get a loan at a pretty low credit score. But I just think that if you took 6 months and you improve your credit score by 100 points, which is doable for many people, it'll make a tremendous savings over the long run. I know there'll be a worry about, you don't want to miss out on the appreciation we're seeing. My instinct is that we're not going to see the same level of appreciation the next 12 months that we've seen in the last 12 months. So, if you're afraid you're going to miss out on that, you've missed out on it. You know, I mean, it is what it is. And I do think, lastly, let me say, you know, the word of advice I would give many people is really make sure that you're moving to a place you want to live. And let me just also just kind of maybe an edit to the previous comment, which is there are a number of places to get your credit reports, and in most of the banks that you might have, you know, when I'm on my mobile app on my bank account, and so I won't bias anybody which bank to like or not like, I won't mention the bank, but, you know, my mobile app, I can check my FICO score any time of day, you know, and there's really a lot of options, and you should really look at that. But again, think about where you want to be over a course of years. Think about, can you be in the property for 3, 4, 5 years? And think about whether it's, you know, the community you want to be in. And, you know, I guess maybe the last year has really impressed upon ourselves, you know, we have all spent a lot more time indoors in our homes than we probably thought we were going to. And I think that's put a real emphasis on, think about, you know, do you need that? You might want a home office when you might not have thought about that before. You might want to be able to spend more time around family because, again, you may not have that opportunity in some ways. So I do think the past year has really brought so many things to bear about what, I guess I'll put it this way, I suspect we all have spent looking back on the past year, really asking ourselves what's truly important to us. And, you know, fundamentally, your choice of where to live is a reflection somewhat of what truly is important to you and the trade-offs that you make in your life. And I think that's really got to reflect on where people are going to want to live, what they're going to want to buy, what they're going to rent. So I hope that's all helpful advice.
No, it's
You know,
it's really great advice for the people that respect you.
Thank you.
You've done a really good job, really fantastic job for all of us, increasing sustainable home ownership and making sure that the people are being helped right now. So, Dr. Calabria, thank you so much. And former Comptroller Brian Brooks, he is a guru of this also. So
he unlike me, he actually is famous.
I am so blessed that I'm talking to a two rock star here, and not only the famous, right? You have a big heart, helping the people. So we thank you so much for this. And I know there's some question, but I know you have to leave. And maybe if Brian can stay a little bit, even just for 5 minutes to respond to some questions.
I could stay for a couple of minutes quickly. Mark, it's great to see you. This was a great dialogue. Really fun.
Absolutely. To do this. Brian, great to see you. Faith, it's great to see you. Thanks, everybody. And, you know, really just, I know many of you know Danielle Walton, who does our external affairs. You know, I apologize about running to the next thing, but just submit questions. We're happy to kind of turn things around or write us. There's contact info on the FHFA.gov website, and we love to hear from people. And especially if you just want to send us a note telling you that you think we're doing great things, we welcome that too. So again, hope everybody.
Thank you so much. Bye-bye. So Brian, Dennis Santiago has a question. So Dennis, go ahead, because he's got only a few more minutes also.
Yeah, thank you. And wow, what an education that was in terms of things. I have actually, and I'm going to limit myself to just a couple of technical questions that I'm asking because, well, Brian, you know, I'm now running the equity share subcommittee of the home ownership committee of LA Reach, of Project Reach, which you started. So here are my two questions. I was sensitized by the discussion about the waterfall effect on the collateral of mortgage modifications and what that does on the financing side of the world in terms of how it affects existing MBS and the structuring of new MBS, and being mindful of the fact that in order to scale any type of initiative, we have to be able to communicate something clear all the way back to the other end of the financial system. You know, it's basically what the guys on the other side of the other end of the Acela train. The other question I had that was continued to be sensitized is this question of the continued shifting of the capital stack to design systems that can reduce or improve the affordability of housing by improving greater reliance on equity as a component to offset debt. And I mean, it's a couple of areas that on the committee work that I'm doing that it's it's very complex to begin with, but any guidance you can offer, man, I could really use the help in some comments.
Yeah, look, I mean, these are both great questions. I think, on your first point about how complicated the historical mortgage-backed security structure is, there's got to be a better way. And the story I always tell about this is in the depths of the financial crisis, when I had first moved, to what I now consider to be my adopted hometown of Los Angeles to kind of try and rescue the failed IndyMac platform. We were working to work through as many mortgage modifications as fast as we possibly could because IndyMac had like 192,000 loans in foreclosure on the day that we bought that bank. And one of the things I discovered was because of the issue you're identifying, there were a number of big mortgage securitization trustees who just wouldn't allow us to do that because they claimed that under the terms of their securities indentures, which are these really 1,000-page long boilerplate form documents, they claimed that we couldn't do that without the individual consent of every holder of a certificate in that trust, which could, of course, never be gotten. And meanwhile, I'm trying to save people's houses here. So at a certain point, I had to go and file a lawsuit against one of the biggest banks in the world who was the trustee of this big trust because I was trying to save like 462 houses in LA County, and they just wouldn't let me, right? And so I had to go get some judge to cut through all of the 1,000 pages of BS to say on an equitable basis, listen, these people can make payments. They have an entitlement to stay in their houses if they can make payments on a basis that is net present value positive to the investor. None of the rest of this 1,000-page document matters. So, that's an actual case that resulted in a precedent that kind of started to make those things simpler. But the normal waterfall as it works in an MBS structure is pretty terrible. And you got to think there's a better way. So that's kind of my quick response to your first question. On question number two, which has a lot to do with LA Reach and about equity as a basis for housing finance versus debt. Look, I'm not somebody who thinks mortgages are inherently a bad thing. There is this concept of good debt versus bad debt, and basically there are two kinds of good debt, right? Student loans for an education that's going to get you a job, and mortgage debt, which is going to help you build equity in a house over time. It's basically leverage. Where things got out of whack, and you heard Mark talk about this, is when we started giving 95%, 97%, even 100% loan to value ratio loans, so it wasn't leveraged because there literally was no equity. At that point, all you were doing was gambling on future price movements of local real estate markets. You might as well be in like the futures or the derivatives business as in the real estate business if you're going to do things like that. That's why the work that you all are doing in Project Reach is so critical, because what it's really focused on is the idea of a way that we can help get people into housing without burdening them with high monthly payments, the upside of which may or may not ever happen, is to have equity sharing arrangements where somebody says, look, I'll invest in this house with you and you won't owe me a nickel. There are no monthly payments at all. Just you give away 5%, 10%, 15% of the future equity appreciation, if any, and I'll get the rest. That's a way of solving the down payment problem and solving the debt burden problem that, especially for low and moderate income Americans, is such an enormous impediment to home ownership. And so to me, that's a much more manageable way, and frankly, a much more humane way of getting people in a situation where they can build wealth. That's the bottom line at the end of the day, is housing is the principal source of wealth for most families. It is virtually 100% of the explanation of the white versus African-American wealth gap is the price and the value of a single family home. And so if we can get what you're doing right, and I've sat down with you and Faith and other leaders of LA Project Reach, if we can model that in that program, I think probably more than anything else any of us is working on, that's going to change the world for the better. So thank you for your work on that.
Well, thank you, and I really appreciate the words of guidance, because there are times I just look at all this data and it just overwhelms my mind.
You would never build the system this way if you were sitting down to build it from scratch. That's for sure. But that's okay. We got a lot of smart people, you included, working on it, which I really appreciate. And with that, Faith, unfortunately, I've got to hop to the next thing, but it's a real honor to be with all of you. It's great to see you all, and hopefully I'll see you all in person next time.